This conversation is for informational, educational, entertainment purposes only. Nothing you hear in this presentation is and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities or instruments in any jurisdiction. The participants in this conversation may and do hold shares in the securities discussed in this presentation. Please do your own research before making an investment decision. Thank you, everyone, for joining us today. I'm Joe Koster, and I'll be hosting this call on behalf of Co-Investor Club. With me are Co-Investor Club team of Lucia, Sam, Adam, and the club's founder, who is also my friend and first boss out of college back in the day, Mike Pruitt. And our special guest of honor is another close friend who I've known for many years, spent over a decade's worth of annual meetings in Omaha for Berkshire Hathaway, and running around Omaha with, having dinners and talking Berkshire as well as other investing topics. And he's also been a mentor for me as well, Chris Bloomstran of Semper Augustus Investments Group. Chris is one of the best and clearest thinkers I know, and amongst outside investors, I consider Chris to be one of the world's foremost experts on Berkshire Hathaway. So Chris, thank you for joining us today. And the topic for today is key takeaways from this past weekend's Berkshire Hathaway Annual Meeting. As I mentioned, Chris is the go-to guy for all things Berkshire. So Chris, let's start with your big picture general impression of the Berkshire meeting this year.
Well, thanks, Joe. Good to be with you guys. I thought this was perhaps the best annual meeting in a lot of years. Last year was so distorted, obviously, by the COVID, and there were a million things going on. Charlie wasn't zoomed in. It was just a very awkward time. It was a tough time. So many of Berkshire's businesses were under duress. I think, you were beyond the March 23 beginnings of the intervention by the Fed and by the Treasury, but there was still a lot of unknowability. A lot of our manufacturing base was still down. So, with Mr. Buffett and Greg sitting in a vacant auditorium where we've all spent so many years together was somewhat disarming. I thought this year, coming out of the year end, there's so much good that's going on. I addressed a lot of it in my annual letter, but they're really firing on all cylinders on the capital allocation front. The media really gets on Mr. Buffett for this apparent enormous cash balance, which really I've written for a handful of years. I try to put it in perspective of the total operations and the total assets of the firm relative to the operating companies. And, they've kind of run, not much less on the cash position for the better part of the last 22 years, really since the Gen Ray deal. And I thought, hearing Mr. Buffett put the cash balance in perspective, that they're really not going to spend the entire $142 billion. But there's, the above and beyond the $20 billion that's earmarked. I've looked at that as more like 1 year's of insurance losses. That's how I think about it. If I was running the place, that's, the minimum cash number I'd keep around. And that number is pushing $40 billion. And then you've got cash that's held at the subsidiaries, the railroad and the utility businesses carry $3 to $4 billion. When I try to distribute capital through the operations, when I do my yearly reconciliation, I think there's probably on the order of $20 billion of cash sitting inside the manufacturer, service, and retail group, which now includes the finance companies. And then you've got some cash at the holding company. Certainly you've got cash balances, which are known at the insurance operation. And, with Berkshire's insurance operations, the invested capital so heavily invested in stocks, you still have a very nominal, modest fixed income balance underneath that. But, you've got, cash between 60 and $70 billion. So, Mr. Buffett talked about the 60 or $70 billion that could be spent. But, my takeaway was great. You've seen over the years, I've learned so much from Berkshire, but really from Mr. Buffett and Mr. Munger. We're all blessed for all of the lessons and the teachings and the chairman's letters, and then in the annual meetings each year. I think Ben Graham being a teacher and so instrumental in Mr. Buffett's outlook and in his life, I think at a point very early on, I think Mr. Buffett became a teacher of sorts, and there'd be no reason for him to have spent as much time and space in the chairman's letter each year teaching us all about, the very important aspects of capital, from capital allocation to taxes and inflation to share repurchases to the use of capital to the treatment of, your clients, your customers, your employees. It's just been a lifelong teaching lesson. And so much of my thinking has been kind of grounded in the Warren Buffett, Berkshire Hathaway mindset. I think at a point of writing, a very instructional, very meaningful letter where over the years he'd give you hints about what he thought the intrinsic value was. I think having done it for as many years, I've written my letters now for 20 plus years, and it's a labor of love, and mine's still an incredibly long document, but, I've kind of modeled my own behavior to a large extent on Mr. Buffett. And I'm so blessed and thankful to be in the position that I'm in, to get to work with wonderful clients, to be able to allocate capital on a daily basis. I've never felt like I've worked a day in my life. And so I'm in part spending as much of my letter giving back, and I think teaching some of the things that I've known, and I'll never do it on the scale that Mr. Buffett has done over time. But, you think about writing that piece and spending as much time as he has over the years with students, originally bringing, individual classes to Omaha, and then, bringing in multiple schools at the same time. He's devoted a substantial portion of time to teaching and giving back to this great industry and this great business. But we've all seen in the letter itself becoming a shorter document. And here in the last 5-10 years, I think it's been less of a teaching document. And for that, I think the annual meeting has really become a surrogate for teaching. And what a wonderful thing to sit every year at the dais for 6.5 hours with Mr. Munger and field questions from the shareholder group. And at the point, the shareholder questions became more generic. Those guys would talk about what they wanted to anyway, and they could spin any question on its head and talk about the things that were relevant and teach about the business, teach about investing, teach about capital, the outlook. And I think then the introduction of the journalists and then the introduction of the analysts helped filter some of that and, try to keep the business a little more grounded on the business itself, the meeting a little more grounded on the business itself. And that was great. So, here we were in 2021 in an abbreviated session. I think one of the classiest things that I've seen out of the place was moving the meeting to LA so they could do it with Charlie. Charlie not being zoomed into last year's meeting, but being very active on Zoom throughout the year. He did the daily journal meeting. He's still brilliant. I've seen no diminution in his capacity to be one of the smartest guys any of us have ever been lucky enough to run across. But, at 97 years old, to save him the trip to Omaha where you don't have a live meeting and you don't get a chance to catch up with shareholders, to move the show for the board and those that were on hand to LA, I think was one of the classiest things that Mr. Buffett has done. And it was great to see those two guys together. I hope we have those guys together on the dais for a lot of years to come. But they're getting older. But you had this short window, and I thought Becky did a great job with the questions. But I think there were elements of teaching that is no longer done in the meeting. But there are some very important things that were said, and Charlie had some great one-liners, as he always does. He was more on point than he's been in a lot of years. But you start the meeting, and you went into the discussion about the companies that sat atop the stock market in 1989, and how many of those companies, 13 or 14, were Japanese. And I think probably nobody in the room would have guessed that none of the companies that were in the top 20 market cap globally in 1989, which was clearly the peak of the Japanese bubble. Japan had grown not unlike the degree to which China has grown coming out of World War II. Japan's economy was a miracle. but their stock market was incredibly overvalued. On top of very high levels of profitability, stocks traded for 80 to 100 times earnings. And for that, the Japanese market on what was about a $5 trillion economy was enormous. So naturally, you had some incredibly overvalued Japanese companies there. But for none of the companies that were sitting at the top of the stock market 30 years later to be gone, none were the largest businesses, I think was a teaching moment. I think given what's gone on in the last year and a couple of months with the government's, the Treasury and the Federal Reserve's intervention, if you will, into our economy, we have a lot of redistribution of capital and wealth. We've got the stimulus checks, and so you see these sheer numbers of retail brokerage accounts, be it Robinhood, we see it at Charles Schwab, you see it at TD. You've got a lot of newcomers to the stock market, and there's a lot of silliness that's going on. Be it, they talked about Bitcoin, they talked about SPACs, but even in conventional businesses that are not yet kind of conventionally profitable with a margin structure, you've got some very, very real parallels to the late 90s. And you go back to that period and all of the teaching that Mr. Buffett was doing at the time about excesses and valuation, and here's the reason why we're not doing tech. So through the lens of talking to the Robinhood investor, if you will, you went through the example of the auto companies, and that might be a case in point for the Tesla crowd, where valuations probably don't make a lot of sense. And I think read between the lines of why you would go through the example of the auto companies that started with M, of the couple thousand companies that no longer exist. He's not teaching a history lesson for the sake of teaching a history lesson. He's hoping, among hope, that people will hear the message and read between the lines and take note that of the 2,000 companies, only 3 in the United States existed before the financial crisis, and 2 of them went through bankruptcy. There's a lesson there for some of the silliness today. And so my takeaway was, there's a lot of good that's going on in the business. Most of the operations are either fully recovered or in the process of recovering from the pandemic and the downturn, and that's good to see. And if you guys want, we can talk about some of the individual subsidiaries and some of kind of what was seen in the Q or even in the year-end annual. But beyond a lot of the good that was taking place, I think there was just a lot of great teaching. And early in the meeting, going through those lessons as he did, that's now the surrogate for what he would have done back in the day with the authored letters with Carol Loomis in Fortune magazine, or some of the things that he would have done in the meeting, and use the stage in LA to do that.
And I think listening to Buffett long enough, and both reading him and being to the annual meetings, as you said, reading between the lines, I feel like him having that at the beginning where he showed the companies from 1989, then later he specifically said something about setting Berkshire up for the next 50 to 100 years, specifically calling Charlie, I think, the chief culture officer now, stressing the importance of the culture. I think those sort of all, as we know, Buffett sometimes will have things he wants to get across. And so when a question comes his way, he'll kind of give the answer he wants to give. And I feel like those sort of all tied together throughout the meeting into kind of the same lesson about, endurance, durability, ability to persist over the long term.
Yeah, and kind of building on that. Oh, sorry, go ahead.
No, go ahead, Adam.
Oh, but building on that, I mean, like historically, Berkshire's number one asset is that they have some of the most patient and intelligent capital in the world. I mean, among almost any business, right? Buffett and Munger don't seem to be, they don't chase the newest trend ever. They chase continuous and constant ROICs. And that, I mean, while you can miss out on short-term gains, and Buffett catches flack from people who don't know really much about investing. What was it? Davey Day Trader came at him 6 months ago, which is silly. But because he misses out on these little bubbles that form, but he's consistently building net value and asset value and capital within the firm. And I think this meeting and this letter really showed that even with I think it was a slight slip when Munger said, Greg will take it over. Greg will continue the culture. And then I think it was just shortly after they said, yeah, Greg Abel is probably going to be the successor. But even that slight slip, if you listen to Greg Abel, I mean, he has all those same principles, and in Berkshire will continue even as they wrap up their careers. And it's just an awesome company. It's really cool.
Yeah, and Chris, I would make your thoughts on those other two gentlemen we saw up on stage this year. And of course, we saw Greg last year, but this year we really got to hear more from Greg and Ajit than we have before, and not just answering questions, but going pretty deep into their area of expertise a couple times. So love to get your thoughts on what you heard from them, and anything new you learned listening to them talk about some of those things.
Well, I think they're both extraordinary individuals. I think the DNA of Berkshire runs deep in their blood. And you can see that. We've had the opportunity as shareholders to see Greg a few times and Ajit a few times in the last three annual meetings. It's obvious that with the appointment of Greg outside of BH Energy to overseeing all of the operations outside of insurance, that he's been devoting a lot of his time to getting his arms around each of the subsidiaries. So there's a transition underway from what has been a very decentralized operation, kind of all running through Mr. Buffett and through Omaha, delegated to the subs. I think that's very much still the case, but we all know that Mr. Buffett's not going to be with us for a long time, or for forever. And they've spent a lot of time. They've answered the question about succession for forever. I mean, since well before I've been a shareholder in the year 2000. They're asked it every year. The subject has been belabored more than any place. And I don't think you could ever bring an outsider into Berkshire and run it, because the culture of the place is so important. I mean, if you were to go through and screen through the meeting, goodness gracious, how many times, and I haven't done this, but how many times was the word culture mentioned? I mean, Charlie's was identified as the vice chairman in charge of culture, and also the chief culture officer. I think that's very much the case. And so, Greg specifically is doing a lot of that. When you think about incentives and motivation, however the various deals were crafted and the incentive structures for each of the managers of the subs, Greg has to be up on all that, and all that has to be done well. And I think there's some drift over time that takes place, and you're replacing managers with managers when they retire, or you have an unfortunate death like we just had recently. So Greg's had his hands full, and he comes at this thing with a great business background. He's done a phenomenal job inside of the energy operation for a long time, and he's been spending obviously considerable time getting up to speed with the whole, and that's what's needed. So it's obvious that the important things to Berkshire are the important things to Greg, and I hope he has a long run. I hope he's with Berkshire for decades to come. I think he's that good, and I think he's devoted the proper time and resources to handling that aspect of the operation. We've all known that Ajit is a treasure forever. Mr. Buffett's talked about it, but you look at the point in time at which he came into Berkshire, took over National Indemnity, and has grown the business into what it is today. I mean, it's an extraordinary thing. You sit here with the reinsurance operation that by capital is by far the biggest reinsurance company in the world. That Berkshire commands, a third of all of the reinsurance capital globally, and they write, less than 10% of annual premium volume, which allows them to have this common stock portfolio. But we've all heard that Ajit can write policies and can think about risk kind of unlike anybody else in insurance. And, I've come to know and believe that he's got a team and a group that are with him, that, if he were to be hit by the proverbial bus or retire at a point, that there's a group in place there that's remarkable. But, his overseeing the entire insurance operation now, I think we've all known, Joe, we've talked about it.
Yep.
In the last handful of years, Geico has trailed Progressive, and Progressive over my investment lifetime 30 years has really been the leader on technology and incorporating, kind of being on the cutting edge into their underwriting operations. You heard Ajit very candidly and very directly point out that Geico had lagged in areas like telematics, and they weren't matching price to risk as well as Progressive was. But the back and forth then between Ajit and Mr. Buffett, and where Geico has kind of embedded advantages and where Progressive has advantages, and that it will take effort, and it's taken effort to close that gap, and they're closing the gap. But I think it's refreshing. How many companies, when we all listen to quarterly calls with management teams, is the fact that you're lagging a competitor brushed under the rug? And you'll never find a place that's more forthright saying, yeah, we've lagged, we've not done as well as we should, but we're fixing the problem. And who knows where we're going to be in a handful of years, but then pointing out that maybe 5 years hence, both those companies will surpass State Farm in the private passenger auto market.
Yeah, I was surprised he was as open about coming out and making that. We're going to be 1 and 2, and I sure hope we're 1, but certainly saying good things that those are going to be the 2 to beat for the next several years. But
yeah, and that's just the math of it. I mean, you look at the growth rate of new policies in force and the retentions of business at both companies, which I follow those closely. And you've seen State Farm's market share drop, by a half point to a point a year. And, they're now running 17-ish% of the market, and they were way over 20% not that many years ago. And, when Berkshire got control of Geico, they were kind of low single digit market share. They've incrementally picked that up to where they're 13, Progressive's a little bit behind. But between them, they are taking share, and they're taking share profitably. They've got structural advantages in terms of their operations. As you pointed out, that Berkshire's got a cost advantage that is unrivaled, and that's the pure internet, pure phone distribution with zero agency, zero broker model. I think they win there. I think they've lagged on, again, things like telematics, but everybody uses telematics now. I mean, this notion that Tesla is going to come in and win the tech game, and they're going to be a better underwriter than a Progressive or a Geico. But there's a lot more than just the technology on the front end. There's decades and decades of underwriting, and how do you handle medical claims, and how do you handle insurance in repair losses, and how do you handle inflation in those aspects. It's just an extraordinary amount of expertise. And yeah, they both sit at the top, but I was thrilled to hear the candor. I think the problem investors have is, again, with management teams that are on hand for 3 or 4 or 5 years, they're highly motivated by the stock price. They're highly motivated by quarterly numbers and performance. And you can see when you're that willing to discuss your short-term, your shortcomings vis-a-vis your primary competitor, really your only competitor, sitting at the top of the heap. You love to see that candor. And
and Buffett talked a little bit about one of the biggest mistakes. I think he said something about he would like to write about it one day, but he'd have to name names about one of the biggest mistakes being, when you have a CEO that's likable and sticks to a strategy that's not working. But a lot of that, as you said, is having that culture where you don't have that candor. And Berkshire certainly at its top seems to have that anyway. And it does sound like I know over the years, you've talked a little bit about some concerns that there was so much reliance on Ajit. Sounds like now you're a little more comfortable in the team behind him, and that going forward on the insurance side.
I am, I'm fortunate to have relationships with a number of people in the Berkshire world. And so tangentially, my understanding is they've got a very good deep bench there. And I think that's part of the culture. I think, early on when Berkshire would buy a company, I think it was just kind of nice for the CEO or the founder of the business to stick around and be part of the Berkshire culture and the enterprise. It was great to spend time with Mr. Buffett. Back when they were younger, you'd fly the jet and pick up a couple of CEOs, and you'd go play a round or two at Augusta National and spend time talking about the business. And, how neat would that have been? Well, those days are long gone. And I think there's naturally a period. I think, one of my concerns with Berkshire has always been are they working on the bench underneath the bench? Are they working on the replacements at the subs? And, that can be the big subs like Burlington Northern, or it could be, any of the tiny businesses. And, I think when you sell an operation to Berkshire, the tendency is, well, you've got capital allocation going on at the headquarters. And, we're going to upstream profits. And, it's not my place to tell Omaha and Mr. Buffett what I ought to be doing with capital out here in the hinterlands. And so you probably had a period, and perhaps a sustainable period, where there's been underinvestment in a lot of places. The old adage, if you're not growing, you're dying. There's a lot of validity to that. It has to be profitable growth. And clearly there are businesses that have proven, and they've used companies like Seas as an example, where there's just not a lot of use for capital, and that money ought to be upstreamed. The railroad, pretty much all of the profitability of that business has been upstream to Omaha for divestment elsewhere, because you've only got so many track miles, and there's only so much CapEx you can spend on an accretive, high return on capital basis. But you've got a lot of what I would call deferred maintenance would be wrong, but I guess, deferred investment in infrastructure. I think, perhaps not enough bolt-on acquisitions when they're accretive and make sense, not enough reinvestment back in those operations. And, I think here we are now with Greg, a couple of years into having his arms around the entire enterprise. I think there's a lot of that going on today that probably didn't go on for a period of time. I think they're drilling down, and Mr. Buffett always would have known. You heard him say he's probably the only CEO in America that doesn't get a monthly rolled up aggregated P&L. And I'm sure that's correct. I mean, everybody's looking at the short-term number, and you don't need it. I mean, as an observer and an investor in Berkshire, I don't even feel like I need the Q. Now, I spend a hell of a lot of time trying to reconcile what's going on at the end of the year. And I try to figure out where the capital is, and where inside the enterprise profitability is great and where it may not be great. And that's taken a lot of effort to do that. But you don't need to know what's going on at all of the 70 or 80 subsidiaries on a month-to-month basis. I mean, clearly he's going to get the individual P&L for each of the subs, and we'll spend more time with those that need it. But you don't need the aggregate. But there's concentrated effort taking place now. I think that Mr. Buffett has gotten older, and he's turned over the operational reins, both in the insurance business and the non-insurance businesses, to allow for this next generation of the people that are going to run the place to really understand the place. And that's richly rewarding, and I can see the results of it in the demeanor and the knowledge of both Greg and Ajit.
And maybe if we go back to Greg and you in the energy business, kind of what you were talking about a little bit, especially let's use the example that Buffett used about the Texas example, where Berkshire Hathaway Energy's, put in a project to sort of reinforce the infrastructure. And if they don't deliver, on their plan by 2023, again, Texas hasn't accepted the deal, but Berkshire would essentially be on the hook and lose out on that $4 billion. Well, to me, that was a great illustration of the advantage by having Berkshire structured the way it is, where you can truly have somebody focused on doing things right, doing things on time, but where they also have enough skin in the game so that in this case, citizens of the state of Texas know that if things don't get done as said, somebody's going to be on the hook for paying for it. So if you can kind of use that example to illustrate the kind of the moat of Berkshire Hathaway Energy a little bit, and the reinvestment prospects for Berkshire Hathaway Energy, which is kind of going to be an engine of reinvestment over the next 10, 20, 30 years and beyond. But
they have a long runway to grow internally that operation. I think they realized early on the opportunity set that was going to come with all of this public policy. And whether you believe some of this public policy in terms of renewables is misguided or whether it's appropriate, I think you can go back to the Carter administration and say we didn't do enough nuclear and we didn't do enough solar. The degree to which fossil fuels may be a finite resource and the degree to which they may be harmful to the environment. There's, science on both sides of the equation, but that doesn't matter because they figured out when they got control of Mid-American early on and then started expanding the operation that that's the direction that we were headed globally. The Paris Accord Greg talked about at length, and some of that was in response to the shareholder proposals via the proxy this year. But, we've known for a long time what they're doing on that front. You can just observe, and I watch the entire electric utility industry, and you could see Berkshire's coal footprint every year declining, and intentionally so. And they realized early on, if we're really going to introduce on scale a lot of solar and a lot of wind into the grid, that you'd have to build out distribution assets. And Mr. Buffett talked about it in the annual report this year, spending $18 billion over a period of years. They drilled down to a little more of that math in the meeting on Saturday. They've already spent $5, they've got another $13 billion to go, but they've already plowed $30 billion into renewables, and you can see that in the footprint. And the way they've structured the operation to retain all of the profitability, if Berkshire's aggregated energy operations, and that's the 3 electric utilities, Pacificorp, Nevada Power, and Mid-American, plus all the pipelines, plus all of the distribution assets in Canada and in the UK, you roll it all up and that operation earns on a kind of a tax adjusted basis about $4 billion. Well, to retain all of that profitability, which no other utility and energy operation does, they're operating in a world that's very dividend intensive, where most of their competitors are yield plays for their shareholder base. The ability to identify these long tail, long run projects where they can invest at good, not great, but good regulated returns in the high single digit, low double digit, kind of depending on the project and depending on the regulatory body. There's an enormous runway to spend capital. And when you retain $1 of profit as equity capital, kind of classically, these types of industries on a regulated basis are, tend to use debt in equal proportion to equity. And that'll run on a 40-60 up to a 60-40 basis. And it doesn't get much outside of that. But, on average, here in the last decade, for every $1 of retained equity, they've been able to spend more than $1 in debt capital. Now you're going to probably maintain that relationship of, 110% or so, and kind of keep that gearing inside that operation at 60 debt, 40 equity, which is about where it sits now. But so you're spending, $7, $8, $9 billion per year. And a lot of that is growth CapEx. That's building out the distribution assets. And, we've said for a long time, you watch this thing, and he talked about it, and these guys talked about it at the meeting. When you build you're building a bunch of wind power in Iowa and in Wyoming, you're building a bunch of solar in Southern California, in Nevada and Arizona. You've got to get it to the urban core. And, the urban core is not necessarily where the wind is blowing all the time. And so you've got to build that distribution capacity. And so Berkshire's been doing that in the West for a long time. It's an enormous opportunity set. It can go on for a very long time. You're going to wind up killing coal entirely here and globally. Under the Paris, I thought Mr. Buffett and these guys have really, and we've seen it, Joe and Mike, for years. I mean, since I've gone to the annual meeting for the first time, and for my history of reading the proxy, you see Berkshire's annual meeting used as a soapbox for a lot of progressive public policy, and a lot of which is well-intentioned, but it's the wrong place and it's the wrong tree to bark up. And so, being pushed on climate change, and even in today's Wall Street Journal, I mean, my God, the journalistic naysayers that follow Berkshire, Mr. Buffett very clearly pointed out, you all have not read our annual filings. Each of the utilities, each of the pipelines file their own SEC reports. Berkshire Hathaway Energy files their own Qs and their own Ks every year. And the climate disclosures in detail have been done at great length. And so, to see, and for them to say, when I thought it was the greatest one-liner perhaps of the meeting, but, when talking about when Greg was talking about what the energy operations have done in terms of signing on to the Paris Climate Accord, and you had 12 or 13 companies that initially signed on, and they committed to reducing by 26 and 28% their carbon footprint and their emissions, and now more recently signing on to a much more arduous goal by 2030 of on the order of 50%. When Mr. Buffett asked Greg, and it was a setup question, but so how many other utilities signed on when we signed on to the Paris Accord? And the answer was, of course, well, Warren, none.
Yep.
That was you're barking up the wrong tree, guys. I mean, we're leading on this front, and they figured out a way to lead on this front and do it at a nice regulated return, which, given the degree to which cash flows into Omaha and into the operation, it's a very, very nice place. And so, if that utility operation is worth somewhere between, call it 60 and 70 billion dollars, it's going to be a much, much, much bigger entity as we move toward more renewables in the grid, both here and abroad. And so deals like you saw in Texas, and deals like the acquisition that's underway of the Dominion assets, the distribution assets, and the LNG terminal. I mean, these are great uses of capital. Texas is a very interesting story in that it's, the Texas grid is deregulated, and I'm not sure where in the course of public policy it makes sense to have your electric power produced on a competitive basis, but Texas did that under ERCOT a bunch of years ago. They've had problems with it. Berkshire had a chance, and I made a mountain of money during the financial crisis when Constellation had a for-profit kind of unregulated gas-fired plant operation get upside down on a derivative book. And Berkshire had a chance to bid on buying all of Constellation when that derivative book was going to bankrupt the parent company. They wound up not buying the asset, but it's pretty clear that because you're running that grid on a for-profit basis and not as regulated as would be the case throughout most of the rest of the country, that you wouldn't invest for the 100-year freeze. And so they had a huge problem, and an enormous amount of dislocation, an enormous economic cost, a cost of life. And so I thought, coming in with a proposal to build whatever it is, 10 gas-fired plants, by November 2023 at a regulated 9.3% return at a capital cost of on the order of $8 billion or whatever it is, really good use of capital. And oh, by the way, we're going to go ahead and slap Elon upside the head for coming in with this counteroffer that would provide 4 hours of power in the event we had an outage. And Greg, I think, snarkily would be wrong, but pointed out that, look, I mean, you guys were down, Texas, you were down for 4 days. Our proposal will give you 7 days of backup power that can be turned on a dime, and we're going to make a 9% return, and we're going to give you a surety guarantee of $4 billion. So like it or not, come get it. If you twiddle your thumbs long enough, we're going to go back to the drawing board on the price, because we're in a very highly inflationary environment at the moment, and our deal is not going to stand for that long, but this is a pretty good deal. And the battery backup and some of these things you can do that may save you a little money up front are not going to solve the problem. And I can't believe the elected officials in Texas are going to go for a plan that will save them a bunch of money and benefit a battery provider when it doesn't solve the problem at hand. So short of putting the entire Texas grid on a monopolistic regulated basis, like is generally done throughout the country, if you're going to run it on a deregulated basis, you got to have the backup power that's in place. And I think, reading between the lines, that my take on energy is, look, we're going to grow the population of the United States. We're going to grow the global population. We're going to make enormous investments in wind and solar, but the degree to which we have to replace the current grid, you can't just do it with wind and solar. First of all, the wind doesn't blow and the sun doesn't shine 24 hours a day. So you've got to have a lot of backup power, which will largely come from gas-fired plants. We're going to need more investment in nuclear over time, but you can't get away from the growth curve of renewables you're going to increase share in renewables, but you're also going to have to net add for a period of, and I don't know exactly where, but 20 years perhaps, we're still going to have to add gas-fired capacity. So, in a pinch, if you've got these backup plants in Texas and we don't make investments in for-profit power, there's an opportunity there to conceivably, convert that backup source of power and build it into a more regulated grid, depending on how public policy takes Texas. But I think it's just a great opportunity to say, look, we've got the money, we've got the skill set to do this. This is hard stuff. We'll make the investment. And I think, you say, why wouldn't private equity come in and compete on scale with what Berkshire's doing? They can't, because of the fee structure of private equity.
Yeah.
You're going to layer on whatever it is, 2 and 20 or whatever the numbers wind up being. There's no take. There's no profit flowing to Omaha. There's reinvestment of profit, but there's no skim off the top of cost. And so you're going to do it on a 50-50 or 40-60 or 60-40 levered basis in terms of the total capital structure. You can't do it more cost effectively than Berkshire is. These are very difficult projects. They line up hundreds of people at Peter Hewitt to figure out how to do this job. They're in a great position to grow as public policy drives more investment in renewables. Rightly or wrongly, they're going to win from this game. And it's an enormous benefit to Berkshire relative to their operating profitability of, kind of mid to high 20 billions of dollars, all in $45 billion when I look at the overall profitability of the company. It's a very nice use of a big chunk of Berkshire's profitability reinvested at a nice return in a low interest rate world in particular.
No, very well said. And Adam, do you have a question? Follow up?
Yeah, I was just in regards to natural gas, it seems as though that's an important part of energy moving forward, particularly because it's like a necessary additive to these green energy sources, which seem to be like the public focus, at least from a governmental perspective. And given the fact that Berkshire Energy has so many assets in the natural gas space, like how does that manifest as a long-term moat or advantage as you look to modernize the national power grid?
Well, that's a great question. So think about it. Presume that we go to high voltage grid and power generation that's all renewables, 100% solar and wind. Maybe we do some nuclear, maybe we don't. But suppose we eliminate gas-fired plants. Suppose we eliminate the internal combustion engine. And think about what that means. You can't do that. We have unrefined crude that we take out of the ground. A fair chunk of our natural gas is produced as a byproduct of the processing and the refinement of crude, of pulling crude out of the ground, right? Think about all of the things that crude oil gets refined into: kerosene, ethylene, propane, gasoline, diesel, all the way down the line to asphalt at the heaviest, at the bottom. So you want plastics, you're gonna have to have refined crude. You want jet fuel, you're gonna have to have refined crude. So we're gonna have a lot of unintended consequences that come from this, but the cost of replacing the coal and the gas and the oil-fired plants in the Northeast, the cost of replacing the grid's productive capacity with simply alternatives are staggering numbers. I've seen $5+ trillion. Now, we happen to be in this insane world today where instead of running $1 trillion deficit last year, we ran a 3.1, we're gonna run a 4 or 5. So all of a sudden, Mr. Buffett said it. He said, all of a sudden we're in this crazy world where trillions of dollars don't matter. I remember when hundreds of billions of dollars didn't matter. Now we're into where we can just gin up trillions of dollars. So maybe we can do it. We don't know, but you're not going to be able to get there because, like I say, you have to have redundancy in power. If you're going to have wind and solar, you can't have rolling blackouts. California can't say we're going to go to a zero carbon footprint and assume we can buy power from Nevada. They have to have their own gas-fired productive capacity, because at a point Nevada is going to say, pound sand, we're not going to send you our power because we need it. So you got to have power. You're going to have more gas. We are going to have to grow the gas infrastructure at the same time as we do. And I think the notion that in Europe and even now here, we're going to identify some of these traditional energy assets as dirty. We don't want to own them. I mean, look at yesterday's announcement where Holly Frontier is going to buy a refinery from Shell in Washington State, the Puget Sound refinery, paying something like 1.5 times EBITDA for it. It's a great asset. It's a scarce asset, but Royal Dutch Shell is sitting over there in Europe where they're ahead in terms of the progressive push on public policy, eliminating the carbon footprint. We're not going to build another refinery in North America. We're not going to build another refinery in Europe. And so all of these gas distribution assets that Berkshire has are going to wind up being scarce assets. I mean, hell, we've been trying to get some of these new pipelines built, and nobody wants it in their backyard. So you can't say, I'm going to be in California or I'm going to be in Massachusetts, and we're going to need power from Wyoming, because I don't want to see a wind turbine off of Martha's Vineyard. But if you're going to have all solar and all wind, you're going to have wind turbines off of Massachusetts. So I just don't see how, being realistic, you can go to a zero carbon footprint and do it anywhere around 2040 or 2050. You can't do it with a growing population. We're going to have gas. And Berkshire is just uniquely well positioned because they're adding these assets to their arsenal. And there's going to be a scarcity factor to these assets, which are going to allow them to make good returns on capital for a long, long time. I think they're just very brilliantly, uniquely positioned. And they figured it out before everybody. And they're in a unique position of being one of the very few, or maybe the only one, that can do it and invest in it on the scale they're doing it. It's perhaps, prospectively, it's perhaps Berkshire's single greatest kind of growth engine and asset, even though none of it's growth. We're investing. It's done on a regulated basis. It's not like we have unit growth and we're not able to raise prices. I mean, the price is very regulated here, but as a matter of building these assets for the social good, you've got to be allowed a regulated return. We have tax policy right now that benefits those that are willing to make the investments, and I don't see that changing. So when you're looking at BHE and it's a smallish, maybe 10% of the value of all of Berkshire, it's going to be a much bigger component, to Joe's point, 5, 10, 15, 20 years from now.
It's well said. And moving on to another Berkshire subsidiary, Buffett had hinted that if Burlington Northern was a public company, it would be valued much higher given some of the other multiples in the market on more pure play public railroads, although there aren't that many of them. Given some of your work and your letters, I think you probably agree with that. So just curious if you learned anything new about Burlington Northern from the annual meeting and over the last few months as the annual report and the latest Q have come out.
No, I'm not sure I learned. I'm not sure there's been much new. Mr. Buffett pointed out that the Burlington Northern is closing ground on kind of an operating earnings basis against the Union Pacific. They had gotten a little bit behind. I don't know whether the BNSF is gonna make the investment and do precision scheduled railroading. All of the other class ones have done so, and they've struggled with it. Being in the West, when you think about how PSR works, it's more like how Southwest runs their fleet on a point-to-point basis versus the old hub and spoke. PSR is similar to that model, and when you're as geographically distributed in the West as the Burlington Northern is versus the Eastern railroads, I think it's a different dynamic. But that said, pointed out that Katie Farmer is doing a great job. They're closing some efficiencies. I think the industry itself, you talk about technological innovation, the labor component of running a railroad. If you watch, the last 3 or 4 decades, we're taking the labor cost of running the operation down to almost nothing. And so, these railroads fared very well during a pandemic, which closed 40% of the manufacturing base of the globe for a period of time. There's a lot of variable cost in the railroads and in the BNSF. And so if their revenues were off by 10%, their profitability was off by 10. They're not operationally leveraged like a lot of other industries would be. And so, they've made a lot of investment. I think my take from my annual reconciliation this year, I have a table in the back of my letter which shows you CapEx versus depreciation at the railroad, at BHE, and then at all of Berkshire. And you can see the degree to which, for a large number of years, both the railroad and the energy operations were spending about $2 in CapEx for every dollar in depreciation. In the last 4.5 years, the cadence of that spending has declined at the railroad. You think about it, they've only got so many track miles. And so it's not like BHE where you've got the ability to go build a new transmission network that doesn't exist. You're not going to add much to that 32,000 mile track capacity other than running the 2 wide, 3 wide, 4 wide, building new tunnels that can accommodate double stack containers, that kind of thing. Well, a lot of that CapEx is behind them. And so they're a little bit more in maintenance mode, they lagged on some operational efficiency, but he said, look, it's just like the analogy between Progressive and Geico. It's in the West, it's the Union Pacific, and it's the BNSF. And, we're very similar. We're a little bit bigger in terms of track miles. And so we should make a little more money over the long haul. We're lagging here, but we're, Katie's on the job and we're watching it closely, and, we're investing appropriately as we should. So in terms of the economic recovery, the business is still off by, maybe 5% from what I would call normal steady state run. But they were impacted by the trade war, well before the pandemic. The number of car loadings had been down for about 3 years, with the exception of agriculture. And you've seen this big COVID bounce back to where we've now got this inflationary environment. But, if you kind of normalize car loadings, we're not quite back to where we are, but things have gotten pretty tight in a hurry. So, profitability at the railroad was probably off by about $1 billion, and they've closed, somewhere between half and 3/4 of that, I would guess. So, it's a great asset. To your point, Joe. I carry it. My valuation is, around $120 billion, $110 billion. Pointed out that if you marked it to the Union Pacific, it would trade more like 150. I said in a prior podcast recently, I think it was the one with Stig, I said 150, $170 billion if you marked it to, the publicly traded rails. And now you have this deal with the 2 Canadian rails buying the Kansas City Southern. And the multiples and the price that they're paying is well north of where the UNP trades. And so, if you mark Berkshire to that, you'd be $170 billion. And I don't carry it for that number. So my numbers are, I think, appropriately conservative, as they are throughout the subsidiaries as I value them on a sum of the parts basis. But it's a great asset. You wouldn't expect it to grow a lot from here. There are no acquisitions to be had. And so, they're going to duke it out for market share in the West with Union Pacific and the Canadian rails. And they've got some competitive threat now by the integration of whoever wins that bidding war at a very high price, which I think at the price they're paying, in all likelihood, will likely be harmful to the economics of the business. The premium is so high, and they talked about that, but you got to fight for the customer. And so the Surface Transportation Board will be involved, and Berkshire will be advocating on behalf of their customers in terms of the competitive threat to having now more competition by integrating the integrated line from Canada deep into Mexico. But all in, I think the railroads operationally doing really well and headed in the right direction.
Great. And on the next topic, Buffett did talk a bit about raised prices and is having prices raised on them. So I think, Sam, you had a question on inflation you wanted to get in here.
Yeah, absolutely. Thanks, Joe. So given the increased risk of inflation and the fact that Mr. Buffett said in the meeting he was seeing inflation all over the company, how do you see this affecting the long-term capital allocation decisions of Berkshire?
Yeah, it's another area where they were just brutally candid. And they're pointing out that in terms of their input costs, their commodity costs, they're faced with it. They're going to have to pass it through to the extent they can, but they're definitely seeing it. I mean, he's got a front row seat to a lot of different industries through the ownership of the various subsidiaries they have. I think classically, if you go back to the inflation we had in the 70s through the early 80s, when you had these very capital intensive assets, and Mr. Buffett pointed out that Berkshire is larger than any other company in North America and maybe the world when you measure on a book value basis, property, plant, and equipment, right? If you have a lot of old assets, whether they're fully depreciated or not, and you have an inflation and a very rapidly rising price structure in places where you're regulated as to regulated profit or to price, where you can't immediately pass through price increases, you wind up in an environment where it gets harder and harder to recover what you would call your historic cost base. It hasn't really been a big issue in the last 30 years because we've had disinflation, after inflation peaked in 1981 and interest rates began coming down. But if we're going to be in a durably higher inflation climate, then you've got to be able to go to the extent you're spending capital, especially in the two big capital intensive places within Berkshire. That's the energy operation of the railroad. You're going to have to be able to get price for this increased cost of replacing your capital stock over time. So all of the maintenance CapEx that's got to be spent, the new growth CapEx, despite the fact you're in a low interest rate environment, if your costs are rising, you've got to be able to recover these higher costs. It's the reason I think that Mr. Buffett pointed out, look, our deal with Texas is on the table for a very limited time because we've got a lot of inflation. Our steel prices, Greg said steel's off the charts. Everybody knows that lumber is way up, but a lot of these commodities are tight. I step back, Sam, and I'm trying to think through the degree to which this is a secular, long-running inflation, or whether this is transitory coming out of a very unusual, very abrupt slowdown where we idled large chunks of the manufacturing base. We had ships that were carrying full to the brim of crude because we couldn't refine it fast enough because there was no end demand for gasoline and the various refined product. So you had inventories build. The ports have had huge problems. You can't get truckers today. So you've got a lot of this, what I think is going to wind up being transient inflation. Housing prices up 12, 13, 14%. You got 20 bidders on a home. Berkshire's raw commodity costs are up in price. And so here you're in an environment now where you better have pricing power. If you're in a place where you're stuck and you don't have price and you can't move price, you're gonna lose on the profitability line. And I think in the markets you're seeing some differentiation now on the winners and losers there. But I think, given the debt levels we have globally, across corporate America, corporations globally, governments, households are actually in better shape than they've been in a long time. I mean, we're doing stimulus checks, unemployment checks. These low interest rates have allowed households to refinance mortgages. We've taken the interest burden down. Households are in good shape. Corporations are not. They drew down their credit lines last year. They took on net debt. They were already extremely levered, more than they've been historically. And so my sense is a debt bubble is worked off through either disinflation or deflation. And as strong as things look now that we're coming off of what was this enormous downturn, your year-over-year comps are going to look really good. So nominal GDP is going to look really good. I mean, it's going to have grown in 2021 at a higher rate than it has for decades. You're going to have easy comps in a lot of places. Some places are going to have tough comps. I mean, businesses that thrived in the pandemic, various retailers, for example, a lot of the home distribution, a lot of the delivery of the last mile, internet sales for retail goods, even some commercial goods. you're going to have some negative comps. But all in, the majority of the economy is running up against easy comps right now. We're going to fix the supply chains. Anybody that can fire up more mining capacity, fire up more steel capacity, they're going to fire it up if people think that this is less than transient. So my guess is when you get out maybe another 9 months, when you get into 2022, you're going to be up against this booming economy and these booming comps. And I think the inflation is not what most people think it is, what the crypto people think it is, and that we're now in a structural inflation, which they infer to be hyperinflation. I think this is just the degree to which the supply chains are completely screwed up at the moment. The fact that Texas had a problem, Lubrizol was, pretty badly impacted by being down, and they had little access to their natural gas feedstock, for example. So manufacturing capacity throughout the entire Gulf Coast was offline for 4 days, and then when you're offline, you can't fire it back up right away. And so all of this is kind of a perfect storm of what I think is very transient inflation. And we could have another discussion about whether we're going to have hyperinflation as a result of the debt bubble and public policy and central banks and governments and their willingness to deficit spend and willingness to redistribute wealth. But that's I think an entirely different subject beyond this current inflation that we're clearly seeing. And it's going to impact profitability in places, and it's going to help in other places. And there'll be winners and losers in 2021. And again, I love to see the candor that comes out of Berkshire. When they're up against challenges, you saw it in Greg. He walked through the examples of where they're seeing inflation throughout the system. They're just more candid than you tend to find throughout corporate leadership globally.
Great. And we'll go with 2 more questions so that I don't keep you all day, because I know we could go forever. But I have a quote here from you, Chris, from a few years ago.
Hope it wasn't on Twitter.
Well, we can get to that later. The businesses at the top of my portfolio are not necessarily going to be the ones that perform the best over the long term, but are the ones I know will perform. And so Berkshire obviously has performed very well. You still sort of peg intrinsic value to B shares somewhere in the 325 to 365 range, according to your letter. You have, your normalized earnings of about 42 to 45 billion right now. Gave you somewhere between a 6 to 7% earnings yield. Over time, as the buyback, maybe price to book will be less relevant. But for now, it's still a pretty relevant of sort of where we are in the valuation, which I kind of got us somewhere around a little under 1.5 on a price to book ratio, maybe a little over 1.5 if you adjust the Apple position down, if you think that one's valued a little bit highly, which possibly you do. So just want to sort of get your thoughts on, let's say, downside protection from Berkshire and sort of your return expectations over the next, say, 10 years, which, I kind of think that's how you usually look at it when you're looking out long term.
Yeah, I use Berkshire as my opportunity cost of capital. If you go through all the accounting machinations that I go through to kind of normalize profitability, is that mid 40s billion. It's probably 44, 45 billion dollars right now. Will grow less prospectively to the extent Berkshire's buying back meaningful amounts of shares, because they're not reinvesting as much retained earnings in the company. They're paying it out to shareholders via share repurchases. But they're only going to do that when the shares are, attractively priced enough. And to your point, you've had a pretty sizable move up. If I had Berkshire trading at very undervalued at year end, and really the 25 billion, $24.7 billion of repurchases that took place last year were done at an average of 105% of book value, which is pretty extraordinary in a world of 0% interest rates. Yeah, Berkshire's up a bunch. I look at it as about the most knowable profit stream that I own. It's diversified, and I can quantitatively and qualitatively measure the moving parts pretty well, just given the years of observing the company and kind of reconciling how the capital works inside the company. But I think durably they earn 10, what you'd call equity now. The book value will change as they buy back shares. If we have a high inflation, a lot of those depreciated assets that are carried at historical cost will have less utility as a measuring stick for profitability. So to the extent Berkshire can take price and increase returns on their very capital intensive balance sheet, book value will have less utility. We'll see if we have durable high inflation or not. But the aggregate of my portfolio outside of Berkshire, I've got companies that earn more like 14 or 15 on equity. I don't lean on a lot of debt. And so, to the extent those places can retain earnings at earnings yields north of what Berkshire can earn, I've got businesses that will do better, but I'm not willing to make any other investment as large as my Berkshire holding because none of them are as known. Single businesses and single industries can change materially. It's back to that table that Mr. Buffett put up, going back to 89. The top 20 companies by market cap, not a single one is there. I try to make it, you guys all try to measure dislocation or where disruption is coming from. You don't know where it is. You don't know where it's coming. But in aggregate, Berkshire's pretty damn predictable. And the problem I have now is, I have cash for some clients and I have cash flows for some new clients. And, I like to make Berkshire a meaningfully large holding as soon as possible. And I have a hard time chasing stocks when they're moving up as fast as they are. And Berkshire's been re-rating. It's gone from very, very, very undervalued to what is still undervalued, but less so. The stock's up more than 20% this year. So, when you saw the repurchases last year that really began in earnest in mid-year in June, Berkshire was buying back shares at the clip of about $3 billion a month, $9 billion a quarter. You got into the first quarter and, in the back of the queue, you can see their monthly purchases and the prices at which they bought the A and the B shares. They bought back $3 billion in January. They bought back $2 billion in February. And they bought back $1.6 billion in February. So as the price has, pretty steadily marched upward, back to the fall, but certainly for the first, 3 months of this year. And then you saw on the front of the queue what the share count was as of the end of the third week of April. They continued to buy back maybe another $1.3 billion if you say the repurchases took place at 400,000 on the A shares. The cadence of buying has slowed as the stock price has risen. And, since April, here we are in May, and the stock has continued to rise. It's going to get to the point where Berkshire's not going to buy it back. I'm going to find it less attractive to buy it. But I'm not at the point, given that it's still trading instead of 75 cents on the dollar a fair value, it's trading at, I just did the math as you were talking, gave me the numbers. Market cap's got to be right at about 660 billion now. So you're trading a little under 15 times what I would call normalized profitability. So it's, 80 plus cents on the dollar a fair value. So, now we've got less than 25% upside to fair value, where we had 33% upside to fair value at year end. And, if that means the stock kind of drifts sideways for a period of time, my preference would be, and I think this is a great lesson for you guys that are young, just coming into the investment arena. Classically, I can see it through my clients. You just see it through human nature. Everybody gets really excited when your stocks go up. I mean, who doesn't like to feel like you're richer? People talk about what's your number, what's your nut, how much money do you need to be comfortable, to be financially independent, to not have to work. So you like to look at your daily holdings. You like to look at your monthly statement and say, great, I'm getting a lot closer to my number. I get depressed when my stocks go up in price. I hate to see Berkshire going up in price, because if Berkshire's in the mode of buying back shares and they can buy them back when they're materially undervalued as they were last year, that benefits me as an owner of Berkshire. When I have dividends from my companies that pay dividends, when I have clients that are net saving, when I have new clients that are depositing, or I have clients that are adding to portfolios, I always have cash. You're always going to have cash flows to deploy. And what do you want? You want low prices, especially in businesses that you want to own for a long time. Now, exact opposite mentality when you own a cyclical, you own an investment that you don't intend to own, as you know, what's now fashionably called a classic compounder. When I have a price target in mind for something that I've bought because the assets are cheap, because it's an energy business, it's cyclical, I'm not going to own it for 30 years. Yes, I want the price going up. And I've got a handful of those in the portfolio, and they're up a whole bunch since last October. You know, my returns are up a whole bunch this year. But, you know, my margin of safety is down because, you know, companies like Berkshire and my compounders are more expensive than they were. You know, I'm just kind of that weird guy that wants stock prices to be low. And so there's still a sizable margin of safety. It's still the most durably knowable $45 billion kind of normalized profitability enterprise. I can mark it down for the stock portfolio being overvalued, and I tend to do that. So I don't use the day-to-day, month-to-month, quarter-to-quarter book value as a proxy for value, because it gets distorted by the current market value of the mark-to-market portfolio. And so I go through all my normalization methods, and I remove, I remove the stock returns, not only from the income statement, from the balance sheet. And so to the extent the stocks are materially overvalued or undervalued, I'll charge my balance sheet analysis for that. But no, it's great. Everybody, I mean, you know, it's great. It's interesting to see Berkshire winning now, given as much abuse as they've taken here over the proxy proposals and having to defend that nonsense. I mean, there's very few in the media that are willing to say, you know, maybe looking at anybody's stock market returns for 1 year or 3 years, is not the way to measure profitability. You know, when you go point to the 10 years of lagging, well, that's the stock price. But remember, when Berkshire bought Gen Re, the stock was really damn expensive. Trading at 3 times book, the stock portfolio was expensive. But on a book value basis, on a return on equity basis, S&P did 7 and Berkshire did 10. You know, they've beat it by the metrics that matter. The growth of the earning power of the organization have outperformed the earning power of the overall stock market, but they don't know how to look at it through that lens. And so for that, you know, you saw the Financial Times had this really nasty, horrible piece about Berkshire's governance over the weekend. And very easy to say Berkshire's lagging in its stock market return. But even there, you didn't even mention that the damn stock's up 20% this year. You said, well, for 1 and 3 years, it's lagging. Well, no. At year end, it was lagging. The stock was only up 2.4% last year. They don't even want to throw Mr. Buffett a bone when the damn stock is up 20+% in a short period of time, and the S&P is up 11. So the things that matter, you know, the things that matter to me as an investor and should matter to you guys or investors is, where can I go buy durable earning power, predictable, knowable earning power at a good price? And so I cheer when Berkshire's cheap. And, you know, I love it when the media and when, you know, kind of these boo birds from the rafters want to come at them because they don't know what's important. And I'd actually prefer to have them continuously piling on and telling me how bad the place sucks, because it helps us as shareholders. If they can buy the stock back cheap, that helps our cause. I mean, I'm almost to the point where I need to stop writing and talking about Berkshire. I'm not sure my blather, you know, does much, but it's a public enough document now that,
well, if
probably
you,
the thing to teach the world what I think fair value is.
well, if you keep talking about Tesla enough on Twitter, you'll get enough haters on Berkshire just to spite you. So, well, we'll go with one more final question. And Sam, if you need to leave at some point, we understand. I know you got to go graduate college today.
No, this is pretty interesting too, though. So.
Okay.
Don't miss your graduation. I mean,
no, I won't. That's later on. Don't worry about it. Thank you.
Congratulations, by the way.
Thank you very much. I appreciate it.
So let's end with a hypothetical question. So Chris, let's say you were elected to the Berkshire Board of Directors, which I, as a Berkshire shareholder, would love to see you on the board, by the way. But what would be the first thing that you'd want to focus on learning more about the company, given the additional access that you'd be granted as a member of the board?
You know, if you think about the 57-year history of Berkshire under the stewardship of Mr. Buffett, the role of the board, his friend, Sandy Gottesman, you know, everybody that's been on the board with him over the years, Ron Olson for years, Walter Scott, these are all accomplished, very successful people. You know, a lot of them were good friends of his. They'd sit on boards together, they'd get together and vacation together. But I mean, for all intents and purposes, it was Mr. Buffett's show. It was Mr. Munger's show. And the job of the board forever was just to get out of the way, right? As they've dealt with succession issues and as they've gotten older, I think my guess would be, and they even talked about this during the meeting this year. I mean, again, I go back to my comment about if you do a control F on how many times the word culture was mentioned, I bet it's more than every other public company in the S&P 500 put together in their, you know, fourth quarter call or their annual meeting. Culture is really important. And so what you have observed is these guys saying we spend a lot of time talking about culture. And I think they've been in a transition period where we've put Greg and Ajit in charge of big swaths of the company. As I mentioned, Greg's getting his arms around it. He's got to be in a position to allocate capital. He's absolutely got the skill set and the tools. But I think that board, you know, even Mr. Buffett said, we're talking about high level things, not whether we're going to do a checkbox for, you know, Larry Fink or for Glass Lewis or for ISS. You know, we don't do nonsense here. We're running a business, but we want the board to understand what's important at the BNSF. And we want the board to know what, you know, Katie Farmer ought to be thinking about in terms of what's going to drive the competitive position and the moat around the railroad going forward. And so I think they've spent a lot of time. And you've got, you know, a very diverse, very good board. There's a lot, you know, the people on that board have bought Berkshire with their own money. You know, they're not given option shares. They're not given RSU shares. The turnover is very low. The ISS people, the Larry Finks will tell you, you can't have these geriatrics on the board because you need fresh turnover. That's insanity. What you need is culture and continuity. And so I think they spend an incredible amount of time on making sure the right people are sitting in the seats that matter. I think prospectively with Mr. Buffett and Mr. Munger gone, boy, the role of that board will go from this transitory period where they get their mind around the place to fighting like hell to preserve the culture. And that would be things like, you know, making sure you've got the right CEO. And Mr. Buffett talked about that. I mean, he's been on the boards, Joe, you mentioned, I mean, where things have gone bad and you get the guy in charge that's running it wrong, who doesn't understand capital allocation, that's going the wrong direction. You may be in a business that's fully being disrupted and you continue to throw money at it. And it goes back to the original three businesses that Berkshire had: the textile operation, diversified retailing, and blue chip stamps. They're all gone. They were all disrupted. They failed. They were terrible businesses. Mr. Buffett was smart enough to pivot. And you're going to have subsidiaries that go through that in the future, and you better have people in charge that understand that. And so, you know, when it comes to capital allocation, and you're in the middle of a financial crisis, and the calls come in, and Goldman wants money, or GE wants money, or somebody's trying to get a deal done with Wrigley, you know, Mr. Buffett can chew on that over the course of a weekend. He can call, you know, guys on the board like Walter Scott and say, hey, Walter, what do you think about, you know, this deal? You know, he's got these great sounding boards that he's leaned on, I think, for a long time. There's a lot of accumulated wisdom and knowledge there in that current board of directors. But Mr. Buffett can make a decision in a weekend. The prospective board will have a lot of interaction with Greg and with Ajit and then ultimately whoever sits in those same seats, and then who sits in the seats underneath them. So the imperative of the prospective board of Berkshire is to, I think, do what they've done for the last 10 or 20 years. And that's culture. That's try to maintain the continuity of the place. Because when Mr. Buffett's gone, you think Glass Lewis and you think ISS and Larry Fink and CalPERS are coming at him now, they're going to come at him even harder. And when Mr. Buffett's A shares over a decade period of time are converted to Bs and sold off, that's going to increase the voting authority of these people that, to Mr. Buffett's point, have never taken the time to read our financial statements, that have never dipped into their pocket. I mean, how outrageous is it that you would criticize the compensation packages of Greg and Ajit, for making, high teens of millions of dollars of compensation when they've been given zero stock options over their tenure at the company. They've been given zero restricted stock shares. Ajit owns a whole bunch of shares, and he has dipped into his own pocket and paid for those shares. So when you take the typical CEO of a Fortune 500 or an S&P 500 company, and you add up base salary, which is nothing, bonus, which is usually $1 million, couple $1 million, but then the value of the packages that they're given via stock, which is dilutive, and to the extent those shares are repurchased at high prices, harmful to the shareholder. You don't have that kind of nonsense going on. So the board will vet acquisitions more deliberatively than would have been the case in the past. And that's a good thing, because I think they're all thinking about the culture of the place and what makes sense. I think the understanding of capital allocation and making sure that the leadership is correct, making sure that the leadership on what has been and what I hope continues to be a very decentralized basis for a long time, that you've got the right people in the seats out of the subsidiary companies. That ought to be the role of the board. And I think that will be the role of the board. And so, things like the nominating committee would not have mattered at Berkshire 20 or 30 years ago. But when you start thinking about replacing Ron Olson, Walter Scott, Sandy Gottesman, these guys that are have been around for a long time, don't criticize them for being old people. Their accumulated wisdom is more knowledge than ISS has ever known. I mean, these guys have forgotten more good things than these people that are willing to vote and use Berkshire as a soapbox will ever know. But you need to replace those individuals with like-minded people that are there to preserve the culture, but that are also bring skill sets of capital allocation and understanding of why we don't pay a regular dividend, and why, if the stock is too expensive and we still can't do deals, maybe at the point they want to pay a special one-time dividend. But the board needs to be on board with that, and not infiltrated with outsiders who don't genuinely understand the culture of the place. So culture is really, I think, is the charge of the board. And it wouldn't be done that way at any other public company. But I think Charlie is right when he says, we think this place can run this way for a long time, because I think they've got the right people sitting in the seats that have been around the Berkshire culture long enough. And I believe when they have their board meetings and their committee meetings, they're focused on knowledge of what's happening. How can we improve? But that board should never be in a position to say, well, I mean, Christ, Barron's just said, we're lagging for the last 10 years. We need to get a new CEO in here. We need to fix this stock price. We need to get the stock up. Wrong mindset, and it has no business being a part of Berkshire. And for as long as they can conserve and durably maintain the culture, I'll own Berkshire as my largest holding.
Well, culture is a great place to end on. And yes, if anybody out there at Berkshire is listening and you're looking for future board members, certainly somebody who understands both Berkshire as well as the importance of keeping that culture as the board's key role. Throw Chris's hat in the ring. But anyway, thank you, Chris, for all the insights, and thank you to the Co-Investor Club team for getting this all organized. To follow Chris, please check out his website, SemperAugustus.com, where you can see all of his client letters, which are great reading for investors of all ages and all skill levels. Or you can also, if you want to see some of his other random musings, check him out at Twitter at Chris Bloomstran. And then to learn more about Co-Investor Club, please check out coinvestorclub.com, or you can check Co-Investor Club out at Twitter at the handle at Co-Investor Club 1. Thank you, Chris. Thank you, Co-Investor Club. And thank you, everyone, for listening.
Thank you. Thanks for putting it together. Thanks, Chris.
Thank you
Thanks,
very much.
everybody.
Thanks so much.